In Westerville, Ohio, a quiet industrial zone hums with hidden energy. Behind massive metal doors lies a company whose technology powers the digital world. This is Vertiv Holdings, the silent architect of data centers, the unseen force behind artificial intelligence infrastructure. Vertiv builds the power systems, cooling networks, and rack architectures that keep the world's computing core alive. But behind this seemingly perfect growth story lies a set of unsettling questions that investors can't quite ignore. Every number looks impressive, yet the market remains uneasy. Tonight, we dig into why. Vertiv's origins trace back to 1965 when a small company called Liebert Corporation changed the trajectory of computing history. Liebert created the world's first precision cooling system designed specifically for computer environments. Before that, cooling technology was largely confined to residential and industrial air systems. No one had designed temperature control capable of stabilizing delicate electronic equipment. Liebert's innovation did more than keep computers from overheating. It created an entirely new industry, data environment management. That moment marked the beginning of the physical infrastructure layer for modern computing. In the decades that followed, Emerson Electric recognized the potential and acquired Liebert. Emerson, already dominant in industrial power systems, began to integrate power delivery, distribution, and climate control into a unified network. From the late 1980s through the early 2000s, Emerson expanded this strategy through acquisitions of Marconi, NUR, Avocent, and Chloride, combining them into a powerhouse division known as Emerson Network Power. This unit became Emerson's backbone, generating strong and consistent profit margins. In standard corporate practice, such divisions are protected and developed, rarely, if ever, sold. But in August 2016, something extraordinary happened. Emerson sold the entire Network Power division to Platinum Equity for approximately $4 billion. For a company as financially healthy as Emerson, the move was shocking. Typically, a profitable industrial division is divested only under financial stress or as part of a well-defined strategic pivot. Emerson had neither problem. The sale was interpreted not as desperation, but as anticipation, a sign that Emerson expected a major transformation in global technology infrastructure. And from that decision, a new entity emerged, Vertiv Holdings. Fast forward to February 2020, when Vertiv went public through a SPAC merger with GS Acquisition Holdings, listing on the New York Stock Exchange under the ticker VRT. The deal was orchestrated by David Coate, the former CEO of Honeywell, who became Vertiv's executive chairman. Coate branded Vertiv as the heart of digital infrastructure, and investors initially agreed. Revenue began climbing rapidly, powered by global data center expansion. Yet the numbers hit a deeper problem. Vertiv's operating margins were unusually thin. Industrial peers often post margins around 10%, but Vertiv's hovered near 4 to 5%. That discrepancy revealed a deliberate trade-off. The company was underpricing its products to capture market share. The strategy could pay off through dominance and scale, or it could permanently erode profitability. That tension became the first mystery in Vertiv's story. In September 2021, Vertiv acquired E&I Engineering, an Irish specialist in high-voltage switchgear and busbar systems, for about $1.8 billion. The acquisition positioned Vertiv closer to full power infrastructure integration, from power input to distribution to IT rack delivery. Under normal circumstances, such a deal is followed by detailed synergy disclosures, cost-saving estimates, and integration roadmaps. Vertiv, however, offered almost no specifics. This silence was striking. Analysts speculated that the acquisition was less about short-term synergy and more about securing intellectual property, blocking competitors like Schneider Electric and Eaton, or consolidating pricing power in a crucial niche. Still, investors were left with uncertainty, a second unresolved layer of the Vertiv puzzle. Then, in January 2023, Giordano Albertazzi took over as CEO. His mandate was ambitious: to transform Vertiv from an industrial supplier into a data center solutions platform. His vision centered on vertical integration, merging power systems, cooling technologies, and rack enclosures into a single ecosystem. The strategy made sense. As AI and hyperscale computing advanced, data centers demanded higher power density and more efficient cooling per rack. Vertiv's plan was to be the sole provider managing all three functions seamlessly. In July 2025, Vertiv took another daring step, acquiring Great Lakes data racks and cabinets for roughly $200 million. This company was a specialist in high-density rack systems designed for next-generation AI servers. What raised eyebrows was the structure of the deal. Vertiv bought the entire company outright. Typically, acquisitions in this segment are phased, partial stakes first, with performance-based expansion, to mitigate integration risk. Vertiv bypassed all that. The speed suggested urgency, perhaps a race to dominate before competitors caught up. Yet, even after the acquisition, profitability in the high-density rack segment showed little improvement. Technology had been gained, but returns lagged. That inconsistency became Vertiv's second major mystery. By September 2025, Vertiv declared a modest quarterly dividend of about 3 cents per share, a gesture meant to reassure investors of steady cash flow rather than attract income-based capital. The following month, the company announced its third quarter results. Revenue of approximately $2.7 billion, adjusted earnings per share of $1.24, and year-over-year order growth of 60%. The company even raised its full-year revenue guidance beyond $10 billion. Every number looked spectacular until analysts dug deeper. Despite stellar figures, the stock reaction was muted. Why? Because the surge in orders wasn't clearly linked to immediate revenue recognition. In manufacturing and infrastructure industries, standard reporting practices include delivery timelines and recognition periods for major contracts. Vertiv's communications focused instead on order volume. That deviation raised critical doubts. Were some of these orders non-binding pre-commitments? Were construction timelines at customer data centers being delayed? If so, then much of Vertiv's apparent growth might represent deferred or unconfirmed revenue. Impressive on paper, but fragile in reality. The next question centered on liquid cooling, the company's most publicized technological frontier. Liquid cooling replaces air with coolant fluid to absorb and dissipate heat from high-performance AI chips. On paper, it's vastly more efficient. In practice, it's expensive to install, complex to maintain, and not yet universally trusted due to leak and safety concerns. Today, the majority of global data centers still use traditional air cooling systems, yet Vertiv markets liquid cooling as if full-scale adoption is already underway. This overstatement, intentional or not, creates another dissonance, a gap between technological narrative and market reality. Finally, there's the valuation puzzle. Vertiv trades at a price-to-earnings ratio of roughly 70x, compared to an industry average near 20x. Such valuations are typically reserved for companies achieving revenue growth above 50% per year or introducing transformative technologies with proven monetization. Vertiv's actual growth rate is closer to 15%. The implication is clear. The market is pricing in an extraordinary amount of faith. Investors are betting not on what Vertiv is today, but on what they believe it will become, the essential infrastructure provider for the AI era. Vertiv's story, then, is a convergence of 4 intertwined mysteries. First, the deliberate margin sacrifice that bought market share at the expense of profitability. Second, the quiet acquisition strategy hinting at undisclosed long-term motives. Third, the widening gap between reported orders and realized revenue. And fourth, the liquid cooling narrative, a technology caught between promise and practicality. These mysteries matter because they reach the company's core fundamentals. Vertiv's value isn't simply a reflection of current earnings. It's a complex equation of timing, execution, and credibility. If the company successfully converts these expectations into tangible results, it could cement its position as the backbone of global AI infrastructure. But if those expectations remain unmet, the very optimism that lifted its stock could collapse under its own weight. Investors, this is where you come in. The numbers are dazzling, but the questions behind them are deeper. How you interpret those questions, as risks or as opportunities, may define your investment outcomes in the years ahead. And to our audience, the Valuester channel is inviting you to participate. If there's a listed, private, or soon-to-be listed stock or crypto project you believe deserves investigation, tell us in the comments below. Your input could shape our next analysis. If you found this exploration insightful, remember, your views, likes, comments, and shares help us continue delivering content that uncovers the stories behind the numbers. Thank you for watching and for being part of our growing community of intelligent investors. This was ValueStir.